All right, so today we're taking a deep dive into Wall Street. Well, not Wall Street exactly. More like into the mind of a Wall Street legend, Benjamin Graham,
Right.
and his book, The Intelligent Investor. And, well, we've got
Yeah.
the revised edition
Oh, nice.
with Jason Zweig's commentary. And that's,
Talk about a value add.
oh yeah, it's like getting a cheat sheet
Yeah.
to Wall Street wisdom from this legend. Plus, we get a modern take on those principles that are, well, timeless.
What I think is so interesting about Graham is
Yeah.
he throws out everything you think you know about investing.
Okay.
You know, you can just forget the get-rich-quick schemes or
Right,
you
it's
know,
like timing the market, yeah.
like trying to time the market, like you're some kind of financial fortune teller.
Right, right.
But Graham, he says intelligent investing is all about minimizing risk
Okay.
and then building your wealth steadily through careful analysis.
So no crystal balls.
Exactly.
No lucky rabbit's foot.
Nope. In fact, Graham, he even uses Sir Isaac Newton as a prime example of how even brilliant minds can fall prey to market mania.
Oh, wow.
You know, remember the South Sea bubble?
Yeah.
Well, Newton, he got swept up in that, and he lost a fortune. And I think he even said something like, I can calculate the motion of heavenly bodies, but not the madness of people.
Oh, that's got to be one of history's most expensive lessons in humility.
Yeah, it really is.
But, I mean, what's the takeaway for us, the average investor?
Yeah.
Does this mean we're all doomed to make the same mistakes as Newton?
Not at all.
good.
I think what's important is recognizing that human psychology,
Okay.
it plays a huge role in investing.
Oh, for sure.
We're all susceptible to emotions like fear and greed,
Right.
and those emotions, well, they can lead to bad decisions.
Right, right.
But Graham's approach, it helps us mitigate that risk
Right.
by emphasizing thorough analysis
Right.
and then a disciplined approach.
Okay, so intelligent investing is about, it's about more than just the numbers.
Yeah.
It's about understanding, like, ourselves
Yeah,
and how our emotions can impact, well, our choices.
precisely. And Graham actually breaks down intelligent investing into 3 core principles.
Okay,
Thorough analysis of a company before buying its stock.
got it.
Protecting yourself against serious losses.
Right.
And then aiming for adequate,
Okay.
not necessarily extraordinary performance.
So it's not about, like, hitting home runs
Not about hitting home runs.
every time you step up to the plate.
It's about making sound decisions over time.
Oh, okay.
It's much less like gambling and more like building a really solid foundation.
Right. But how does that work in practice?
Yeah.
Because most people think that investing IS about beating the market.
Right. Well,
Okay.
that's where Graham gets really interesting because
Yeah.
he was deeply skeptical of market timing.
Interesting.
Yeah, and he debunked a lot of popular myths, like the January effect.
Yeah.
You know, that claim that stocks just magically outperform in January?
Right.
Well, he looked at the data, and there was no consistent evidence for it.
I see. I see.
No evidence at all.
I remember reading about James O'Shaughnessy in the book,
Oh, yeah.
and he was a money manager who claimed to have this, like, foolproof formula
Right,
for beating the market.
right.
And his system supposedly turned $10,000 into millions in just a few decades.
Yeah, but there's a catch.
Okay.
O'Shaughnessy's formula, it only worked for a specific period,
I see.
and when the market conditions changed,
Yep.
his system fell apart.
Wow.
And Graham, he uses this story, and others like it,
Yeah.
to show the inherent flaw in trying to predict those market movements.
Okay.
So past performance,
Yeah.
never a guarantee of future results.
So if we can't rely on those market gurus or those
Yeah.
magic formulas,
Right.
what's the alternative?
Yeah.
How do we actually build an intelligent portfolio?
Yeah. Well, Graham's answer is what he calls the defensive portfolio.
Okay.
And he's not talking about being timid or anything.
Okay.
He's talking about building a portfolio that protects you from those major losses.
I see.
It means diversifying between stocks and bonds,
Okay.
focusing on high-quality companies,
Okay.
and then avoiding speculation like the plague.
Got it.
He even recommended keeping some of your money in precious metals like gold
Oh, wow.
as a hedge against inflation.
He makes a pretty interesting comparison in the book
Yeah.
between market valuations in 1972
Mm-hmm.
and then in 2003, showing the valuations were much higher in 2003.
Yeah.
And he seems to be saying
Mm-hmm.
that investors, well, they need to adjust their approach
Right.
based on market conditions.
That's one of Graham's key points,
Great.
He understood that the market is constantly evolving
Yeah.
and investors need to adapt.
Right.
He was a big proponent of rebalancing,
Oh, okay.
which just means periodically adjusting your portfolio
Mm-hmm.
to maintain that original stock and bond percentage.
I see.
It's a way to stay disciplined
Yeah.
and to avoid getting swept up in market swings.
Which is what Graham warned against, right?
Exactly.
Making emotional decisions
Yeah.
based on, well, either fear or greed.
He's all about minimizing risk
Mm-hmm.
and achieving consistent long-term returns.
What about practical tips
Yeah.
for us? I mean, the modern investor, like today,
Yeah.
does Graham offer any advice that we can still use?
Absolutely.
Okay.
Graham, he was ahead of his time
Okay.
in many, many ways.
Yeah.
He was a huge advocate for index funds,
Yeah.
which offer diversification at a low cost
Right.
and then dollar cost averaging,
Okay.
which helps smooth out the volatility of those market fluctuations
Yeah.
by consistently investing over time.
Yeah.
And those are strategies that remain relevant
Okay.
even in today's, well, fast-paced market environment.
But what about those of us who are maybe a little bit more adventurous
Yeah.
in our approach?
Yeah.
Looking for those higher returns.
He does.
Yeah.
He makes a distinction between the defensive investor
Mm-hmm.
and the enterprising investor.
Okay.
But it's not about your risk tolerance.
Okay.
It's about how much time and effort you're willing to put in.
I see.
So an enterprising investor is willing to roll up their sleeves
Right.
and do that deep research
Whoa,
to
whoa.
uncover the hidden gems in the market.
So it's less about picking between like risky or safe,
Yeah.
and more about choosing the level of, well, engagement that you're comfortable with.
I like that.
Like, are you a casual hiker
Yeah.
or are you a mountain climber?
Yeah.
Now, Graham, he had some serious warnings for those mountain climbers.
Oh, yeah, he did.
He was very wary of IPOs,
Mhm.
secondary offerings,
Mhm.
and those hot new issues that everyone's chasing,
He really saw them as overpriced. Okay.
and driven by hype rather than substance.
He didn't just talk the talk.
No,
He used historical examples to back up his claims.
absolutely.
Yeah.
Like the dot-com bubble,
Yeah.
where investors got burned by chasing the latest tech craze
Right.
without considering the fundamentals. And his warnings,
Mm.
they're timeless reminders that hype,
Mm-hmm.
it's not a substitute for analysis.
So we've established that thorough analysis is key. But what does that actually look like?
Yeah.
How do we go about finding those bargain issues in today's market?
Well, that's where we get to the heart of Graham's approach, security analysis.
Okay.
And it's about understanding the financials of a company,
Yeah.
looking beyond the surface, and
Mhm.
uncovering the true value that might be hidden
Yeah.
from the casual observer.
Right. Right.
And for Graham, security analysis, it wasn't about those fancy algorithms or,
Right.
insider trading.
Yeah.
It was about rolling up your sleeves.
And really digging into a company's financials.
I see.
He emphasized looking at those key metrics like earnings, debt, and asset value.
Okay.
He argued that it's not enough to just look at revenue growth.
Okay.
You have to understand the underlying health of the business.
So it's like the difference between
yeah,
judging a book by its cover
right.
and actually,
Reading it.
reading it. right?
Exactly. And Graham uses the example of Chrysler,
Okay.
a company that experienced some incredible earnings growth.
Okay.
But ultimately, they crashed and burned.
Oh, wow.
And why?
Yeah, why?
Because their success, it was built on this shaky foundation of debt.
Oh, I see.
They looked great on paper,
Right.
but if you actually dug deeper into those financials,
Yeah.
you would seen the cracks.
So how do we avoid
Yeah.
falling into that same trap?
Yeah.
What are some of the red flags?
Well, one of Graham's favorite techniques was looking for what he called net nets.
Nut nets. Okay.
These are companies that are trading for less
Okay.
than their net working capital.
Okay.
Imagine getting a house
Okay.
for less than the value of the furniture inside.
Wow.
That's essentially what a net represents.
That sounds amazing.
Yeah, it is.
Are there any downsides to this approach?
Of course, it's not, a foolproof system.
Well.
You still need to consider factors like management quality,
Yeah.
transparency,
Yeah.
and that that overall economic environment.
Right.
So finding a net is really just the first step.
Okay.
You still need to do your due diligence
Right.
and make sure the business is fundamentally sound.
So it's not just about finding a bargain.
Yeah.
It's about, well, it's about understanding the whole picture.
Exactly.
Right. Right.
Now, this brings us to one of Graham's most famous analogies,
Okay.
Mr. Market.
Mr. Market.
So he personifies the market as this fickle, emotional character who's constantly offering to buy or sell stocks at different prices. So some days Mr. Market is euphoric and will pay top dollar for anything.
Right.
Other days, he's depressed.
Okay.
And he's practically giving stocks away.
It's like having a roommate who's constantly trying to sell you their stuff
Right.
based on their mood swings.
That's a great way to put it.
Right.
And Graham's point is that, well, we shouldn't let Mr. Market's emotions
Right.
dictate our decisions.
Right.
We should see his mood swings as opportunities.
Okay, I see.
So when he's feeling down, well, we can buy from him at a discount.
Okay.
When he's overly optimistic, we can sell to him at a premium.
That sounds great in theory,
Yeah.
but I mean, how do we apply that in the real world?
Yeah.
It's hard not to get caught up in in the market's frenzy, especially when everyone else seems to be making a killing.
That's where Graham's concept of margin of safety comes in.
Oh, yeah.
It's one of the most important principles in his entire philosophy.
So this is where you aim to buy assets
Yeah.
for significantly less than their intrinsic worth, right? Like having a built-in buffer to protect you.
Think of it as a safety net.
Okay.
So no matter how good you are at analyzing a company, you can never predict the future with 100% certainty.
Right, of course.
Things can change.
Yeah.
Markets can crash.
Yeah.
And even the best companies can stumble.
Right.
But margin of safety, it helps protect you from permanent capital loss,
I see.
even when things don't go according to plan.
He even connected this to the difference
Yeah.
between stock earnings and bond yields.
Mm-hmm.
He argued that stocks, with their higher risk, should offer, well, a greater potential return compared to bonds.
You're getting it.
Right.
Graham, he wasn't just throwing out, arbitrary advice.
Right.
He grounded his principles in solid financial logic.
I see.
He wanted investors to understand that price is what you pay,
Well,
but value is what you get.
and he uses a really compelling example in the book to illustrate this point.
Mm-hmm.
Showing how even a company with impressive growth
Right.
can turn out to be a bad investment
Yeah.
if you overpay for it.
It all comes back to that margin of safety. So buying a great company at a fair price, it's much better than buying a fair company at a great price.
Right.
So that margin of safety, it helps ensure that, even if your analysis is slightly off,
Okay.
you're still protected from significant losses.
So is margin of safety still achievable in today's market?
Well,
Especially when everything is, seemingly priced for perfection.
that's the question that every intelligent investor, they need to grapple with. It might be more challenging in today's environment, but Graham would argue that, it's more important than ever to be disciplined and patient.
Right.
Don't just chase the hottest trends.
Okay.
Look for value where others are afraid to look.
Now, speaking of looking for value,
Yeah.
Graham didn't just tell investors what to do.
No.
He showed them how to do it.
He did.
And he dedicated, a significant portion of the book to the practicalities of security analysis.
That's one of the things that makes The Intelligent Investor so enduring. It's not just a collection of abstract theories.
Yeah.
It's a hands-on guide
Right?
to evaluating companies and making, informed decisions.
And he didn't shy away from sharing his own methods.
Right.
He even revealed that net approach
He did.
that we talked about.
He believed that knowledge is power.
Right.
And investors should be equipped. Yeah.
With the tools to understand and evaluate for themselves.
Right.
But he also stressed that security analysis
Yeah.
is just one piece of the puzzle.
So what else did he consider essential?
Successful investing.
Yeah.
Well, for Graham,
Mm-hmm.
understanding the market itself,
Right.
it was crucial.
Right.
He challenged the idea that you can consistently buy low, sell high.
Yeah. Buy low, sell high.
Yeah.
That's kind of, I think a lot of people
Yeah.
assume that that's the whole point
Yeah.
of investing.
It's a catchy phrase.
Yeah.
But it oversimplifies the complexities of the market.
Right, right.
Graham argued that, well,
Yeah.
instead of trying to outsmart the market,
Yeah.
we should focus on understanding the true value
Okay.
of businesses.
So think like a business owner,
Yes.
not a stock trader.
Exactly.
Okay.
And to make decisions
Yeah.
based on a company's fundamentals
Okay.
rather than those short-term price fluctuations.
So it's about shifting your mindset
Yeah.
from like a gambler
Right.
to a business analyst.
Precisely.
Okay.
And he even compared buying a stock
Oh.
to buying, a small share
Okay.
in a private business.
Okay.
And you wouldn't constantly check the value
Right.
of your share every day, would you?
No, of course not.
Or panic over, those minor fluctuations. You would focus on the long-term
Yeah.
health and profitability of that business.
So, okay, so if we're not supposed to be
Yeah.
checking stock prices
Right.
every 5 minutes,
Yeah.
what should we be paying attention to?
Well, Graham believed in identifying
Yeah.
those undervalued companies.
Okay,
So those trading for less than their intrinsic worth.
I see.
And he provided several methods for doing this, like analyzing those financial statements,
Okay.
understanding competitive advantages,
And then assessing the management quality.
and of course using his
Yeah.
his net approach
Exactly.
to find those hidden bargains.
Now, what about those
Yeah.
who prefer to rely on the experts?
Right.
Can those professional money managers
Yeah.
do all this for us?
That's what we pay them for.
Well,
like
Graham,
that.
he had some strong opinions about the mutual fund industry.
Okay, like what?
Well, he was critical of
Yeah.
their high fees
Yeah.
and their tendency to chase performance
Okay.
rather than focus on value.
So even the pros can fall into the trap
Mm-hmm.
of emotional decision making
Yeah.
and market hype.
Yeah.
That's a bit unsettling.
It is.
Right?
And Graham's point was that, well,
Yeah.
we should be wary of anyone claiming to have a foolproof system
Right.
or a guaranteed way to beat the market.
So it's back to the idea of trust but verify.
Precisely.
Even when it comes to those professional money managers.
He encouraged investors to,
Yeah.
to scrutinize the fees,
Right.
the investment strategy,
Right.
and that long-term track record
Right.
before handing over their hard-earned money.
It seems like a lot of people would be surprised
Yeah.
to learn that Graham, he wasn't totally against speculation.
You're right.
Right.
He acknowledged that that speculation has a role in the
Yeah.
market,
Right.
but he emphasized the importance of keeping it separate
Okay.
from intelligent investing.
Great.
He warned against using borrowed money
Yes.
for speculation
Mm.
and urged investors to be aware of those psychological biases.
He used some pretty strong language
Yeah.
comparing it to, gambling and
Yeah.
even addiction.
He wanted to make it clear
Right.
that speculation, it can be seductive
Yeah.
and lead to irrational behavior.
Okay, so intelligent investors,
Yeah.
they should focus on the long game.
The long game.
Right. Building wealth steadily and sustainably,
Yeah.
not trying to get rich quick.
Exactly.
Yeah.
It's about having that clear understanding
Yeah.
of your goals
Mhm.
and the risks involved.
Right.
Now, Graham, he also had some interesting insights into the role of dividends.
Oh, yeah.
Oh,
He was
yeah.
a fan of dividends, wasn't he?
He was, yeah.
Oh,
Graham saw dividends as tangible evidence of a company's, financial health.
Okay.
It was a way for investors to
Yeah.
share in the profits of the business they own.
Right.
He argued that companies, they should prioritize
Oh,
paying out a substantial portion of their earnings as dividends
okay.
instead of hoarding cash
Uh-huh.
or engaging in,
Yeah.
excessive stock buybacks.
Which is something that we see a lot of today,
we do.
right?
Yeah.
Companies buying back their own stock
Right.
instead of paying dividends.
And Graham, he was ahead of his time
Yeah.
in recognizing those pitfalls of stock buybacks.
Right.
He argued that, they could be used to manipulate
Yeah.
earnings per share
I see.
and enrich those corporate insiders
Wow.
at the expense of the long-term shareholders.
So it's not always a good sign then
No, this is
when a company announces
yeah.
a big stock buyback program.
It's important to understand a company's motivation
Okay.
and the impact on shareholder value.
Okay.
Graham, he believed dividends were,
Yeah.
a more transparent way and
Yeah.
a more equitable way
Okay.
to distribute those profits
Right.
to shareholders.
He even suggested that investors should actively engage
Yeah.
with company management
Right.
and advocate for policies that benefit
Right.
long-term shareholders.
He did.
Okay.
He believed that shareholders had the right
Right.
to hold management accountable and to push for policies that maximize shareholder value.
It's a reminder that investing is about, owning a piece of
Yeah,
the business,
this-
not just trading pieces of paper.
Right.
So let's talk about Graham's concept of margin of safety again.
Okay.
He called it, the central concept of investment.
Mm-hmm.
And it seems to tie everything together.
You're absolutely right.
Right.
Margin of safety, it's all about buying those assets for less
Yeah.
than their intrinsic worth.
Okay.
So it provides a cushion
Yeah.
against, those unforeseen events, errors in your analysis, or
Okay.
even just market fluctuations.
Okay.
And he even drew a connection
Yeah.
between margin of safety and the relationship between stock earnings and bond yields.
Yeah, he argued
Yeah.
that a sufficient margin of safety exists
Right.
when the earnings yield on a stock,
Mm-hmm.
so earnings per share divided by price,
Yeah.
is significantly higher than the yield on high-quality bonds.
Exactly.
So you're essentially getting a higher potential return
Yeah.
from the stock
right.
to compensate for the additional risk.
Yes.
Okay.
You're being rewarded
Right.
for taking on that extra risk.
Right. And Graham pointed out
Yeah.
that this margin of safety, it was much more significant
It was. Yeah.
in his
Yeah.
time
Yeah.
when stocks were,
Yeah.
generally cheaper
Mm-hmm.
compared to bonds.
Right.
And he even expressed concern
Hmm.
that in the 1970s,
Mm-hmm.
this margin of safety was shrinking,
It was.
making it tougher
Yeah.
to find those truly undervalued opportunities. So was he saying that it was becoming harder
He's definitely.
to invest intelligently?
He was highlighting the challenges
Okay.
presented by,
Yeah.
by those changing
Yeah.
market conditions.
Well.
But he also offered some advice for navigating,
Yeah.
this new landscape. Okay. He suggested focusing on those low multiplier stocks,
Okay.
companies with those strong balance sheets,
Right.
and then those with a proven track record
Oh.
of dividend payments.
So even in a trickier market,
Yeah.
intelligent investing,
Yes.
it's still possible.
It is.
It might just require
Yeah.
more work.
It might, and Graham's insights, they remain incredibly relevant
Oh, yeah.
even decades later.
And speaking of relevance,
Yeah.
the revised edition includes
Yeah?
Jason Zweig's commentary,
It does.
which provides a modern lens
Yeah.
on Graham's principles.
Zweig's commentary is fantastic.
Right.
He gives those updated examples,
Okay.
explains those complex concepts
Yeah.
in a clear and concise way,
Right.
and even offers practical tips
Right.
on implementing Graham's strategies
Okay.
using modern tools
All right.
like online brokerages
Yeah.
and index funds.
He even included a section called the Investor's Owner's Contract,
I love that.
which is basically a pledge
It is.
to avoid emotional decision making
Yeah.
and to stick to
Right.
a disciplined investment plan.
It's a great way to commit to being an intelligent investor
Yeah.
and staying true to Graham's principles.
It's a reminder that the biggest risk in investing
yeah.
isn't the market itself.
No, our own
Our own behavior.
right. Our emotions.
Our biases.
We all have biases
Yeah,
and
yeah.
emotions that can lead us astray.
Yeah.
And both Graham and Zweig, they provide valuable insights
Yeah.
on how to recognize and overcome those pitfalls.
So it's not just about picking the right stocks.
Yeah.
It's about,
Becoming the right kind of investor.
yeah, okay.
Now, to appreciate the depth of Graham's wisdom,
Okay.
I think we need to dig into a few case studies
Oh, okay.
from the book.
Okay.
He uses real-world examples
Okay.
to illustrate, those principles of intelligent investing. Okay.
And the consequences of ignoring them.
I remember reading about the rise and fall of AAA Enterprises,
Oh, yeah.
which was built on the hype of franchising,
Right.
but eventually went bankrupt.
That's a classic example
Yeah.
of how speculation and hype can lead to,
Yeah.
disastrous results.
Okay.
Graham, he also analyzes the collapse
Oh.
of the Penn Central Railroad,
Okay.
once a blue chip company
Right.
that crumbled under poor management and
It's-
financial mismanagement.
And then there's Lingtemco Vought Inc.,
Yeah.
a conglomerate that
Yeah.
grew rapidly
Mhm.
through acquisitions, but ultimately, well, it buckled
It did.
under a mountain of debt.
And those case studies, they're like mini thrillers,
Right.
full of drama and intrigue,
Okay.
but they also provide, well, those valuable lessons
Okay.
about the importance of due diligence,
Yeah.
understanding those financials.
And then avoiding the allure of speculation.
They're a reminder that even
Yeah.
seemingly successful companies
Right.
can have those hidden weaknesses
They can.
that can unravel.
Graham wasn't just trying to, to scare investors. He was
Right.
trying to educate them.
Okay.
Wanted to show them,
Yeah.
well, those potential pitfalls
Right.
so they could avoid
Right,
making the same mistakes.
So instead of just focusing on the winners,
Yeah.
he also showed us
Right.
how to learn
Yes.
from the losers.
Now, in addition to these cautionary tales,
Okay.
Graham, he also highlights those positive examples
Oh.
of intelligent investing.
Okay. Like it.
Well, he talked about Walter Schloss,
Oh yeah.
a legendary investor who
Yeah.
achieved some amazing returns
Right.
using a simple value investing approach.
Right.
So Schloss was a disciple of Graham,
Mm-hmm.
and he consistently outperformed the market by buying undervalued stocks
Okay.
and holding them for the long haul.
So he was the epitome of patience
Yeah.
and discipline.
And his story,
Yeah.
it's a testament to
Right.
the enduring power of Graham's principles.
And Graham even shared his own investment record, demonstrating how he achieved
Right.
those impressive returns
Yeah.
by sticking to that value-oriented approach.
And his personal example, it's incredibly inspiring.
Yeah.
It shows that intelligent investing,
Hmm.
it's not just a theoretical concept,
Right.
but it's a practical strategy
Yeah.
that can lead to real-world success.
Right.
And he emphasized that
Yeah.
this approach isn't just for, those Wall Street hotshots.
Right.
It's accessible to anyone
Right.
willing to put in the time and effort
Right.
to learn and apply those principles.
It's not about having a fancy degree
Right.
or those insider connections.
It's about having the right mindset,
Oh, yeah.
the discipline to follow a proven strategy.
And that's what makes The Intelligent Investor
Yeah,
such a timeless classic.
it really is.
It's not just a book about investing.
Yeah.
It's a book about thinking clearly
Yeah,
and making sound decisions
it is.
in all aspects of life.
I agree.
Now, okay, so we've covered a lot of ground here,
Yeah.
from analyzing those companies to
Mhm.
understanding the psychology of the market.
Mm-hmm.
I think there's one more key concept that we need to unpack.
Yeah.
The idea of market fluctuations.
You're right.
Right.
That's where Graham's, that famous Mr. Market analogy,
Right.
it really comes into play.
Yeah.
Remember, he depicts the market as this emotional entity
Right,
who's
yeah.
constantly offering to buy or sell those stocks
Right. At those fluctuating prices.
at those fluctuating prices.
It's like having that unpredictable roommate who's
Yeah.
always trying to
Trade.
trade possessions. Yeah.
Right.
And Graham's point is
Yeah.
that we shouldn't let Mr. Market's mood swings
Right.
dictate our decisions.
Right.
We should see his fluctuations as opportunities.
So buy low when he's feeling pessimistic.
Yeah.
And then sell high
Right.
when he's overly optimistic.
Sounds simple enough.
Right.
Easier said than done.
Yeah. I imagine so.
It's hard not to get caught up in
Right.
the frenzy
Yeah.
when everyone seems to be, making a killing.
Right.
But Graham, he argued that the real danger for investors,
Okay.
it isn't in the market. It's
Yeah.
in their own emotional reactions.
So it's about keeping a cool head
Keeping a cool head.
when everyone else is
Yeah.
losing theirs.
Exactly.
Okay.
He encourages investors
Yeah.
to focus on the long term.
To view themselves as those business owners
Okay.
and to make decisions based on careful analysis.
Okay.
Not that short-term market noise.
So in a way, it's about
Yeah.
turning Mr. Market's weakness into our strength.
Precisely. Now, to illustrate the power of Graham's approach,
Yeah.
let's look at some real-world examples of companies that have stood the test of time.
Okay.
Didn't Graham talk about Geico?
He did?
Vico, that was one of his favorite investments. It's a great example of a company
Yeah.
that's delivered strong returns for its shareholders
Right.
over the long term.
Okay.
And Graham, he admired their low-cost business model,
Okay.
their focus on customer service,
Right.
and their disciplined management team.
What about Coca-Cola?
Oh, yeah.
That's another brand that seems to be
Right.
like eternally successful.
Coca-Cola, that's a classic example of what Graham called a franchise business.
Right.
Okay.
They have a powerful brand,
Mm-hmm.
a loyal customer base,
Right.
and a durable competitive advantage.
Okay.
Graham argued that, these types of businesses,
Yeah.
they're more resistant
Okay.
to those economic downturns,
I see.
and they have a higher likelihood of generating, consistent profits over time.
It's about finding companies that have that secret sauce,
Yeah,
that special something that sets them apart
you got it.
from the competition.
But Graham also acknowledged that that even the most successful companies,
Yeah.
they can stumble.
Right.
And he highlighted examples like the Pennsylvania Railroad,
Oh,
which
yeah.
was once, a giant of American industry, but eventually went bankrupt.
So it's a reminder that no company is invincible,
No.
and that even blue chip stocks,
Mhm.
they can fall from grace.
Graham's analysis of these cases.
It highlights the importance of
Yeah.
constantly reevaluating our assumptions, not taking anything for granted,
Mm-hmm.
and being vigilant for those potential red flags.
So no matter how strong a company seems,
Yeah.
things can change.
They can?
And intelligent investors,
Right.
they need to be prepared for the unexpected.
You never want to put all your eggs in one basket,
Right.
no matter how sturdy that basket seems.
So diversification
Yeah.
is key,
It is.
even when investing in, seemingly unshakable blue chip companies.
Absolutely.
Yeah.
So I think that wraps up our deep dive into the intelligent investor.
Yeah, I think so.
We explored
We covered a lot.
the fundamentals of intelligent investing,
The pitfalls of speculation,
psychology of the market.
the importance of patience,
So
and the power of independent thinking.
I think Graham's his most important message
Yeah.
is that the biggest risk in
Yeah.
investing,
Yeah.
it's not the market.
Right.
It's ourselves.
Our emotions, yeah.
Yeah, our emotions and our biases.
And by understanding that and by mastering our own minds,
Right.
by following these principles,
Those principles of intelligent investing. Yeah.
we can achieve financial security
security.
and build lasting wealth.
It's a journey of self-discovery as much as it is
Yeah.
about understanding the market.
It's a powerful reminder that,
Yeah.
that investing,
Yeah.
it's not just about picking stocks.
Yeah.
It's about making those rational,
Mm-hmm.
disciplined
Mm-hmm.
decisions
Okay.
based on, based on those sound principles.
Well, thank you for guiding us through this deep dive.
Yeah.
It's been incredibly insightful.
It's been my pleasure.
And until next time.
Happy investing.